Hey guys, Chris from Adapttuition here, and in this video I'm going to show you how to prepare a direct materials purchases budget for a period of 3 months. Now this is a relatively new topic that has only been on the CSEC syllabus since about 2017 for first examination in 2019. However, as of the date of this recording, which is around May 2021, it has not yet been brought on a CSEC PoA exam. So I want you to know how to do it should it come on your exam. You can find this topic in section 11 of the current iteration of the CSEC PoA syllabus, which is called Accounting for the Entrepreneur. Also in that section you will find things such as schedule of cash projections, sales budgets, production budgets, and business plans, as well as employees' pay. Now this budget is not mentioned specifically by name, it just says production inputs. Now if you followed my manufacturing account video, which I'm going to put a link to up there and in the description, you will know if you are manufacturing, you need inputs into your production process: materials, labor, and overhead. So because this is the CSEC level, I'm focusing specifically on the two most important inputs and two simplest inputs: materials and labor. And of course in this video I'm going to focus on the direct materials. Okay, so with that said, let's take a look at some of the information. Alright, so it says the direct materials purchases budget. So this budget shows the quantity and value of units of direct materials that need to be purchased in order to meet a given production volume and maintain a predetermined or minimum level of closing inventory. Okay, so let's see if I can get a little example going so you could kind of connect with that before we get into the other, actual examples and numbers and these things, right? So let's say you have a hobby of making sourdough bread and you got so good at it that your friends and relatives encouraged you to take it up as a business. And you said, all right, I'm going to do this thing. But of course, a very important question you should ask yourself is, all right, if I'm going to do this thing, what ingredients do I need? Now, for the sake of simplicity, let's just assume you need flour. Now, I know, yes, to make sourdough bread, you need more ingredients than just flour. But again, for the sake of simplicity for the example, I'm just going to assume one ingredient. Okay, so let's say you make your plan that you're going to start up by making 100 of these sourdough loaves. You're going kind of ambitious, right? And through your experimentation, you realize that it takes 2 pounds of flour to make 1 loaf of sourdough bread. So if you're aiming to make 100 loaves and you need 2 pounds of flour each, you're going to need 200 pounds of flour. Now let's just say from your private experimentation, your previous production of this bread, you have 20 pounds of flour left over. So you don't need to purchase a full 200. You can simply you can take the 200 you need and subtract the 20 you already have, which will give you 180 pounds of flour that you need to buy. And let's also assume the flour costs $5 per pound. So you're going to take the number of pounds you need to buy and multiply by the cost per pound. So 180 by 5 will give us $900. So what you've just done there is you've created a direct materials purchases budget. The direct material being the flour, that material which is directly involved in the production of the bread. You looked at how much you need to produce your target output, which was the 100 loaves, and you looked at how much you already had, which was 20. You found the difference, which was 180, and you multiplied that by the cost, right? There's only one slight little thing we have to add here just to make it a complete budget for this particular item. And that item is a closing stock. So let's say, for example, in this world right now, we have the whole COVID-19 situation happening, and in some places we aren't as free to go to the grocery or supermarket as we would like. In some cases, supermarkets are making deliveries, but they are a bit delayed. So let's say you are being prudent and you said, hey, what? I need these 200 pounds of flour and I want to get 25% extra in case I can't get to the grocery on time or in case the deliveries are running late. So again, we want to make 100 loaves. We're going to take 2 pounds of flour per loaf. So 100 by 2 gives us 200 pounds of flour. We also want to have an extra 25% of that amount of flour on hand in case, once again, we are unable to go to the grocery on time or deliveries run late. So 25% of 200 is 50. So we want to buy, or we want to have 200 available plus 50 extra. So we need 250. Again, you have 20 pounds left from your earlier experimentations and testing. So 250 minus 20 will give us 230. And that's the amount we need to buy. So you took your production requirements, you added your closing stock, you got what you needed to be available, and you subtracted your opening stock, what you had already. And the difference, what you end up with there, that figure, that 230, That is the amount of the number, of pounds that you need to buy. That is the quantity. Now the price, like we said, was $5 per pound, right? So 230 by 5, if I'm not mistaken, if my maths goes correctly, is $1,150. So that is the direct materials purchases budget. We look at the quantity that we need to purchase and the value, the price that we need to pay. And of course, looking at these things, it will help us because we will see if one, we have enough materials available for production, and two, if we have enough money to be able to pay for the materials. And if we are short on either front, and we know that from beforehand, we can try to come up with a solution for that particular problem. And that, of course, is one of the biggest advantages of budgeting. And again, I'm not going to get into too much of the theory behind budgeting right now and list a set of advantages, disadvantages. I will encourage you to check your textbook, to do some Google research, or to look at your notes from your teacher and make your own list. And you know what? Share that list down in the comment section below and I'll pin the best list. Okay, and after all that, let's take a look at an example. So example 9 says no increases. So we're taking a simple example to start with. So we have Tone E-Stock needs to produce 10,000 units of output per month for the first 6 months of 2019. Each unit of output requires 5 units of direct materials. His opening stock of direct materials is 12,000 units, and he plans to maintain an ending inventory balance equal to 10% of the following month's production requirement. Each unit of direct material costs $10. Prepare a direct material purchases budget for the first 3 months of 2019. Okay, so we have a lot to unpack there. Now, instead of trying to talk through it up in the air, I'm going to show you the format now, and we're going to go through it piece by piece. So just like with the example with the sourdough bread, we need to know how many loaves we needed to make in order to calculate the number of pounds of flour we needed to buy. So here, the loaves, well, whatever he's making, 10,000 units of output. And each unit of output requires 5 units of direct materials. So if he's making 10,000 units of something, and each of those units requires 5 units of materials, we are going to need to multiply 10,000 by 5 to find the quantity of direct materials he needs for his production requirements. So let's go down here, and we're going to fill in Jan, Feb, and March, 10,000, because they told us he's going to make 10,000 units of outputs for the first 6 months of 2019. So Jan, Feb, and March, the number of units to be produced is 10,000. And then we're going to multiply by 5, right? So this piece here will be by 5, and we're going to multiply to get 50,000. And of course, we could just mirror that across here for these items as well. Cool. So this row here tells us the materials required for production, which we got once again by multiplying the number of units we intend to produce by the number of materials, the quantity of materials per unit that is required. Now, what did we do after that? We looked at the closing inventory. Do we want any closing inventory? Okay, so it says he plans to maintain an ending inventory balance equal to 10% of the following month's production requirement. So for January, we need a closing stock of 10% of the following month's production requirement. The following month is February. The production requirement is 50,000. 10% of 50,000 is 5,000. So we need 50,000 for production plus an extra 5 for closing stock, which means we need a total of 55,000 pounds or units of material on hand. Now, what did we do with the sourdough bread? Remember, we had a 20 pounds of opening stock, which we did what with? We subtracted it from the required amount we needed. So his opening stock of direct materials is 12,000 units. So guess what we're going to do with that? We are going to subtract it from the 55, and that's going to give us 43,000 units. So that is the quantity of materials we need to purchase. And now we need to show how much that's going to cost us. So each unit of direct material costs $10. So all we have to do is multiply by 10, and we're going to get the total value of direct materials purchases for January. And now we simply continue for February and March. So the closing stock for any month is 10% of the following month's production requirements. Now, thankfully, all of the months for the first 6 months of the year have the same number of units to be produced, the same requirement of materials per unit, and therefore the same materials required for production. So it means that the closing inventory will be 10% of the same 50,000 for the first 5 or 6 months. So we're seeing it there, 5,000. And what do? We then add going down to get 55,000. And now we need to subtract opening inventory. Now the opening stock from any given month is the closing stock from the previous month. The closing stock from January was 55. The closing stock was 5,000. Right, and we're going to need to subtract that here. So the closing stock of one month becomes the opening stock for the next month, right? So 55 minus 5 will give us 50. And we multiply that by the cost per direct materials unit, right, which is $10. And then we get $500,000 worth of materials. And that will actually be the same thing across here, because the closing inventory from February will become the opening inventory for March. So and then we subtract that from the amount that we need, which will give us 50. We'll then multiply by 10, which will give us $500,000 worth of materials. All right, so with that in mind, if you need to take a pause to copy the format down or take a screenshot, you can do that. So I'm going to put up a question for you guys to try now. Okay, so this is practice question 9A. Now, this was part of a larger handout, so that's why it's question 9 and not question 1. All right, so let's take a read. So it says, can you stop needs to produce 20,000 units of output per month for the first 6 months of 2018. So that's 20,000 units per month of production of finished units. That's not the materials. Each unit of output requires 2 units of direct materials. So that is what we need. 2 units of materials per unit of output. Her opening stock of direct materials is 10,000 units, and she plans to maintain an ending inventory balance equal to 10% of the following month's production requirement. Each unit of direct material costs $5, and they want a direct material purchases budget for the first 3 months of 2018. Okay, so what I'm going to do is I'm going to put up the format just in case you didn't get a copy it down or you feel you need it for help. So you can take a pause, take a read, try the question, and then we're going to correct it together. Okay, ready? Let's go. So the units of output to be produced was given to us up here, 20,000 units per month for the first 6 months. Right, so we're seeing 20,000 units going straight across Jan, Feb, and March. Now we also know that each unit of output requires 2 units of direct materials. So if we put that in here, we're going to get, well, it's just 2, right? And we have to multiply going down. And 20,000 by 2 will give us 40,000. Now, time for an interesting part, the closing inventory. So let's go back to the question, the information in the question, and take a read. So it says she plans to maintain an ending inventory balance equal to 10% of the following month's production requirement. So the ending inventory in any given month is 10% of next month's production requirement. So this row gives us the materials required for production in any given month. So we need 10% of the following month's sales. So 10% of 40,000 is just 4,000. And what do we do with the materials required for production and the closing stock? We add them to find out how much we need to be available in total. And 40 plus 4 will give us 44. Right, and what do we do from here now? Well, we have to subtract the opening inventory, right? So if we know how many units we need on hand, and we have some opening stock, well, we could subtract the opening stock from how much we need to find out how much we have to buy. So what is the opening stock? So it says the opening stock of direct materials is 10,000 units. So in January, we're going to see the 10,000 there. So we're going to subtract going down. 44 minus 10 will give us 34. And we need to multiply that by the purchase price per unit. Up in the question, we see that each unit costs $5. So we're going to put that in down here and then multiply 34 by 5. And that gives us $170,000 worth of purchases for direct materials for January. Now, let's finish February and March. So the opening stock for February, right, so remember the closing stock from any given month becomes the opening stock for the next month. 44 minus 4 will give us 40. 40 by 5, I believe, is 200,000. All right, and that's actually going to be the same exact thing for March, because the closing stock for February will become the opening stock for March, which is the same 4,000, and then 44 minus 4 will give us 40, and then we're going to multiply that by 5 to give us the total value of materials purchases for March. Okay, so that was the first example and the first question for you guys. Let's take a look at a slightly more complicated example. Okay, so in the first example, we considered where we had the same level of sales or production rather over a period of time. But of course, I mean, that is not necessarily a safe assumption in every given scenario. We may have ups and downs in terms of sales levels, production levels. So what we're going to consider now is a steady increase. So let's take a read of the example, right? So we have, look at that, plans to produce 10,000 units of output in Jan 2015 and will increase output by 1,000 units for each of the next 5 months. So output will increase by 1,000 units for each of the next 5 months. So from January to June, output will increase by 1,000. All right. Each unit of output requires 2 units of direct materials. Okay. His opening stock of direct materials is 5,000 units, and he plans to maintain an ending inventory balance equal to 10% of the following month's production requirement. Each unit of direct materials costs $2. Prepare a materials purchases budget for the first 3 months of 2015. Okay, so the only change that we have going on here now is the fact that, look at that, plans to increase output by 1,000 units per month. So we're going to start in January with the 10,000 units we have there. If we increase by 1,000 units in February, that means we're going to be selling 11,000 because 10,000 plus 1 is 11. And in March, we're going to have 12 because 11 plus 1 is 12. That's the number of units we're going to produce. We need materials to produce output. And we are told here in the question that each unit of output requires 2 units of materials. So all we have to do to find the materials we require is multiply how many units of materials each unit of output uses. And that was given as 2. And when we multiply going down, we're going to find the number of units of materials we need in any given month for production. So 10,000 by 2 is 20,000, 11,000 by 2 is 22,000, 12,000 by 2 is 24,000. Now we consider the closing inventory, which tends to be a little tricky. So let's take a look at that. Because remember, if we want a little extra on hand in case supply chains run slow the following month if there are any delays, we need to add a little extra onto the production requirement, or if there's any wastage or whatever the case is. So let's take a look. So it says he plans to maintain an ending inventory balance equal to 10% of the following month's production requirement. Okay, it means that the closing inventory in Jan will be 10% of the following month, February's production requirement. The production requirement in February is 22,000, 10% of which is 2,200. In February, the closing stock will be 10% of the following month's production requirement. So 10% of 24,000 is 2,400. Now we come to March, and that's interesting and a bit challenging because we're going to need 10% of April's production requirements. But we don't have a column for April. But what we could do is we could do our working on a little scrap paper somewhere to figure it out. Now it's not actually that hard. We could simply look at the increase here, 20, 22, 24, and we could probably make an intelligent guess that April's going to be 26. But how do we know that for sure? Well, let's go back to the top. We know that production is going to increase by 1,000 every month. So in April, the production requirement will be 13,000. That's the number of complete units, finished goods. We also know it takes 2 units of materials per unit of output. So 13,000 by 2 will give us the 26 that we guessed, right? And 10% of that 26 will give us, 10% of 26,000 will give us 2,600. Okay. So you see, it wasn't that bad. And what we have to do now is simply add going down in those 3 columns. All right, so 20,000 plus 2,200, 22,2, 22 plus 24, 24,4, 24 plus 26, 26,6. And we simply subtract opening inventory. Now, at the very start, his opening stock was 5,000 units, so we're going to put that here. Now for February, remember the closing stock of any given month becomes the opening stock for the next month. So the 2,200 from Jan will become the opening stock for February. The closing stock from February will become the opening stock for March. And all we have to do is subtract going down in each of the months. And now what we have to do is simply multiply the number of units of materials we have to purchase by the purchase price. And it says up here, each unit of direct materials costs $2. Okay, so we're going to multiply by 2, and we have 17,2 by 2 is 34,4. 22,2 by 2 is 44,4. 24,2 by 2 is 48,4. All right. So now, time for a question for you to try. So let's take a read. So it says You're a Little Late will produce 25,000 units of output in Jan 2014 and plans to increase output by 5,000 units for each of the next 5 months. Each unit of output requires 10 units of direct materials. Her opening stock of materials is 15,000 units and she plans to maintain an ending inventory balance equal to 20% of the following month's production requirement. Each unit of direct material costs $5 and they want a materials purchases budget. Alright, so again, I would invite you to take a pause, take a read, try the question, and let's correct. Okay, how did it go? Had a little trouble? That's perfectly normal. Alright, and we're going to correct it now, so you'll see if you made any mistakes anyway. It says You're a Little Late will produce 25,000 units of output in January and plans to increase output by 5,000 units per month for each of the next 5 months. So if we start with 25,000 in January, we're going to add 5,000 to that to get the production for February, which is 30,000, and then we're going to add 5 to that to get 35,000 for March. Okay, now that we have the number of units to be produced, we need to figure out, well, how much materials will that require? We are told up here, each unit of output requires 10 units of direct materials. So all we have to do is multiply these figures by 10. So we're going to get 250 for Jan, 300 for Feb, and 350 for March. All right, next, what do we need to do? We need to add closing inventory because remember, we need to have some for production and some extra in case anything happens. Now, what is the information regarding closing stock? We need 20% of the following month's production requirements. So for January, we need 20% of February sales. 20% of 300,000 is 60. For February's closing stock, we need 20% of March's sales. 20% of 350 is 70. And what about March? We need 20% of April. What is that? Now, again, you could look here and see that this was increasing by 50,000 per month. And we know that that will hold for the next 5 months because of what the question told us here. If we want to do the long way, so we're increasing by 5,000 per month in terms of units produced. So 25 plus 5 is 30, 30 plus 5 is 35. So in April, we'll have 40,000 units of output to be produced. Each unit of output requires 10 units of materials, which means 40 by 10 will give us 400. And then 20% of 400 will be 80,000. All right, see, wasn't so bad. Now, to find the units we need available for production, we're just going to add going down. So 250 and 60 is 310. 370 is 370. 350 and 80 is 430. Now we need to subtract opening inventory. And opening inventory at the start was 15,000 units. So we're going to start with 15,000 here. Now, the closing stock of any given month is the following month's opening stock. So we have 60,000 for Feb, and the closing stock in Feb is 70, which means the opening stock in March is going to be 70. And we're just going to subtract that to give us the number of units to be purchased. And we are told each unit of direct material costs $5. So all we have to do is multiply by 5 to get the total value of purchases for each of the months. All right, so I have one more example and one more question. Let's get to it. All right, so in this example, we're going to take a look at where volume and price increases. So Fill Her Up will produce 25,000 units of output in Jan 2015 and plans to increase output by 5,000 units for each of the next 5 months. Each unit of output requires 10 units of direct materials. His opening stock of direct materials is 50,000 units, and he plans to maintain an ending inventory balance equal to 20% of the following month's production requirement. Each unit of direct material currently costs $5, but, and this is the new thing here, the price is expected to increase by $1 every month for the next 5 months. So that is the added bonus in this question here. So we want a direct material purchases budget for the first 3 months of 2014. Okay, so let's take a look and see what's going on. So let's start, of course, with the units of output to be produced. So we have 25,000 units of output in Jan, and we have plans to increase by 5,000 units each month for the next 5 months. So if we start with 25,000 in Jan and increase by 5, we're going to have 30 in February, and we're also going to have 35 in March. 25 plus 5 is 30, 30 plus 5 is 35. Now we are told each unit of output requires 10 units of direct materials. So we need to multiply each of these numbers by 10 to figure out what quantity of materials we require for production. So we have 250 in Jan, which is 25 by 10. 30 by 10 is 300 for February. 35 by 10 is 350 for March. Okay. We also need to add closing inventory, again, because we might need a little extra left over for next month in case the deliveries run late or whatever the case is. What is the story with ending inventory? So he plans to maintain an ending inventory balance equal to 20% of the following month's production requirement. Okay, so the ending inventory for Jan will be 20% of February's production requirement. 20% of 300,000 is 60. Now, well, 60,000. So for February, we need 20% of March's production requirement, and 20% of 350 will give us 70,000. Now for March, we need 20% of April. So you know the drill by now, right? We could either look at the pattern right here, which is an increase of, well, 50,000. So we'll probably have 400,000 in April, 20% of which is 80. If you want to go back to the top here, okay, so we increase them by 5,000 per month. So 35 plus 5 is 40. We multiply 40 by 10 to get 400, which was the same figure we talked about just now, and 20% of 400 is 80. Right, we're going to add going down in each column, and we're going to get 250 and 60 is 310 for Jan. 370 is 370 for Feb. 350 and 80 is 430 for March. Okay, next we have to subtract opening inventory. So for January, the opening inventory was 50,000 units, sorry. So we're going to put that here, and 310 minus 50 will give us 260. Now, the opening stock for Feb, how do we get that again? Well, the closing stock of any given month is next month's opening stock. So 60 comes down here, and then for February, the closing stock for February is the opening stock for March. So we're just going to subtract those two columns going down. 370 minus 60 is 310. 430 minus 70 is 360. Okay, and we need a purchase price per unit. So the purchase price, this is where the new thing comes in. Each unit of direct material currently costs $5. But the price is expected to increase by $1 every month for the next 5 months. So currently costs $5 per unit. And then it's going to increase by $1 per month for each of the next 5 months. So 5 and 1 is 6, and 6 and 1 is 7. And now we simply multiply going down in each column. 260 by 5 will give us 1.3 million. 310,000 by 6 is 1.86. 360 by 7 is a little more than 2.5 million. All right, so as we see, things don't always stay static and simple, but we need to know how to deal with it. So time for a question for you guys to try. All right, so this was Not Enough Mon, and plans to produce 20,000 units of output in Jan 2016, and will increase output by 5,000 units for each of the next 5 months, okay? Each unit of output requires 5 units of direct materials, and opening stock of direct materials is 40,000 units. Plans to maintain an ending inventory balance equal to 10% of the following month's production requirements. Each unit of direct material currently costs $2, but the price is expected to increase by $1 every month for the next 5 months. Now, I'm just using $1 to keep things simple, but it could increase by 50 cents, it could increase by any amount. It might even decrease. That's highly unlikely, but you never know. But what it's training you to do is to keep multiple things in mind, because again, things don't always stay static. So they want a direct material purchases budget for the first 3 months of 2016. So now would be a good time to take a pause, take a read, try the question, and then unpause so we can correct. Okay, how was that? It was a little more challenging? That's good. Where there's challenge means there's opportunity for growth. All right, let's take a look at this. So let's start with the number of units of output to be produced. So that's 20,000 units of output, and then we're going to increase that or increment that by 5,000 per month. So 20 plus 5 is 25 for February, and 25 plus 5 is 30 for March. Now, each unit of output requires 5 units of direct material. So we're going to just put the 5 there, and then we're going to multiply going down. That's going to give us 20 by 5 is 100,000 for Jan. 25 by 5 is 125 for February, and 30 by 5 is 150 for March. Now don't forget, we're going to add the closing inventory onto that to find the total quantity of materials we would like to have available. So what do we know about closing inventory? It's supposed to be equal to, he plans to maintain an ending inventory balance equal to 10% of the following month's production requirement. So the closing stock for Jan is 10% of February's production requirement. 10% of 125 is 12.5. Closing stock for February is 10% of March's production requirement. 10% of 150 is 15,000. And now we come to the missing figure. Aha! So the closing stock for March is 10% of April's production requirements. Now, again, we could take a shortcut and look at the increase here. This is an increase of 25,000 because the number of units is increasing by 5,000 per month. And then we need 5 units of materials per unit of production, and 5,000 by 5 is 25,000. But again, if you want to take it the long way, we were increasing the output by 5,000 per month. So for April, 30 plus 5 is 35,000. Multiply that by 5 will give us 175. And then 10% of 175 will give us 17,500. See, not so bad. So we're going to add, going down in each column, 100,000 plus 12,5 is 112,5. 125 plus 15 is 140. 150 and 17.5 is 167.5. We also now need to subtract opening inventory. Opening inventory of 40,000 units, so we have that there. So we're going to subtract that from the 112.5, and that's going to give us 72,500. Now what about February? How do we get opening stock for February? Well, the closing stock of any given month is the opening stock for the next month. So 12.5 will come down here, and then the closing stock for Feb will be the opening stock for March. All right. Then we're going to just subtract in each column. 140 minus 12.5 is 127.5, and 167.5 minus 15 is 152.5. And we have this last little complication here. So each unit of material currently costs $2 per unit, but is expected to increase by $1 every month for the next 5 months. So in January, we have a cost of $2 per unit, but it's going to increase by $1 every month for the next 5 months. So we're going to have $2 in Jan, plus 1 means $3 in Feb, plus 1 means $4 in March. And then we're going to multiply going down and get those figures for the value of direct material purchases for Jan, Feb, and March for this particular company. Okay guys, so there you have it. That's about it for the direct materials purchases budget at the CSEC level. I know at the CAPE level it could be a little more complicated, but we'll get to that eventually. So if you guys want to see any more videos, I'm going to put some cards up here. Don't forget to subscribe to my channel and click the notification bell so you know every time I drop a new video. Check out my website for some free PoA handouts. And as per usual guys, thank you so much for watching. Take care of yourselves, and I'll see you next time. Bye.